Well, David Mahon is founder and executive chairman of Mahon China Investment Management.
The outlook we take is reasonably confident that China will get around 5% GDP growth this year. But a lot of that will come from government stimulus. It's not random stimulus. It's very focused in the high technology sector. And also there's a lot of money being put into public works, into things like hospitals. For instance, Heilongjiang province has just launched a 1 trillion RMB development package. So all these things will help lift the economy through the year. And also the government has lowered the reserve ratios for the banks. So they're now down about 25 basis points, and mortgages too, in some cases 20 basis points cheaper, and more, in other cases 60 basis points cheaper. So there's certainly going to be momentum in the economy, even if the current COVID problems in Shanghai, which is about, the Huadong area is about 30% of the economy, persist for another 3 weeks. So it's going to be okay. There's some caveats, but it looks okay.
It's going to be okay with some caveats, but what might the impact be, do you think, of this slowdown on China's trading partners?
Well, of course, there's going to be tremendous disruptions globally. The war in the Ukraine is a part of that. And also we've got the logistical truncation from the 2 years of COVID, where shipping has been a nightmare for most companies exporting around the world. But strangely, China in the last 3 months has had almost unprecedented export growth. Last year it had 15%. This year we were expecting that it will be an aggregate of about 10%. But it was 16% in January and also in February. And it seems to have been around 14% in March. So China is exporting a lot more than it anticipated. Plus, its trade in the first quarter with the European Union and the US is over 160 billion US dollars. I think some 800 trains have traveled from Xi'an to Germany carrying goods. So there's a lot of activity despite global disruption. So China is very much at the core of global supply chains. And at the moment it looks as though it is unlikely to be hit as hard as many Western countries.
One more quick question. The saga around the Chinese developer Evergrande, that's also been weighing on investor sentiment in particular, hasn't it?
That's a huge concern because, of course, foreign investors have been heavily exposed to property related shares. Many of them hold bonds from property companies. And Evergrande is a problem. And the property sector has other companies, not as large as Evergrande, but pretty large and similarly challenged. Unfortunately, foreign bondholders will lose, and that business will slowly be restructured. China won't let it go bankrupt quickly. That doesn't happen here. Not out of some command economic abstract idea, but it just sees that it brings more stability to the sector. So in a sense, the property sector will not be a good sector to be in for foreign investors if you are owning shares in property companies. But if you're owning shares in companies lending to the property sector and they're strong and they have good reserves, those are very good investment bets.